Drew. Good morning. Good morning. Happy Tuesday. Hope everybody is doing well in the chat. Market is getting some continued downside from yesterday. I'm getting a little bounce back now, but we had some earnings this morning we're going to talk about. It's going to be a fun morning. Shy, how we feeling?
It's yeah, like you said, continued volatility. I don't know if Bitcoin's still under 90K, but I saw that had a pretty tough night last night, and there is some air to be filled below 90. So I am the reason I'm like talking crypto or Bitcoin is like that is one of my risk barometers is crypto. If that starts deteriorating, especially with the risk on fade that we risk off environment we're kind of in right now, where it's more cyclical. It's people don't really want to own the growth tech right now. There's a repositioning that's occurring. It's somewhat worrisome. So today is a pretty big day, but I was just like I said yesterday morning, like I just wouldn't put too much weight on anything that happens until Wednesday afternoon. That's gonna be the biggest tell. But I'd like to see Palantir go from -4% to up 2% pre-market. So that could be the other barometer of like, oh, maybe there is somewhat of a not dead cat bounce, but some stability before tomorrow's like massive Super Bowl of earnings.
Yeah, for sure. Well, we had Hims earnings going on yesterday. Let's see what numbers they got. Well, they had a double beat. I haven't even looked at the chart, Shy. I'm sure you have, but up 2% on revenue, almost 2.5. EPS beat by 10%, so looking good there. Overall, Hims and Hers demonstrated a strong performance in 2024 with ambitious plans for future and growth through innovation and personalization in healthcare. However, it must address regulatory challenges, margin pressures, and competitive dynamics to sustain its momentum. I'm curious on your thoughts with this because we talked a lot about Hims and kind of the bearish side of things. But what do you think of this earnings report, Shy?
Yeah, so before I start speaking, everyone should know I'm a Hims long-term bear, so this could be tilted what I'm about to say on their my reaction to their earnings, but the biggest red flag was clearly the margin compression. Like gross margin in Q4 came in, I think it was at 77%. It missed estimates of 79%. It's also down from last year at 82%. That's where pricing power, that's the barometer for pricing power. And my biggest bear thesis on Hims is they're got a lot of the market share right now in what they do. However, you see clear signs of Amazon trying to disrupt their space, and you're also seeing even Google entertain getting into the space as well long term. These are two massive whales, like especially Amazon, because Amazon's going really hard in telehealth space, and that's going to come at the um, margin pressures. And the reason for that is Amazon can underprice anything that Hims does because everyone in the world is an Amazon Prime member now. Everyone. So they have the luxury of just infusing telehealth into their ecosystem without having to be a standalone product. And that's what Hims is gonna feel that pressure. I'm not gonna say I've been very adamant Hims won't go to zero. I just think they're gonna go through a re-rating due to this competitive pressures. And their margin profile is gonna be drastically different. And that's going to be reflected in their multiple. So I think this, I'm not saying this is the beginning of the end for Hims, but we saw clear signs of there is margin pressure. That's the biggest red flag. And also their weight loss segment has been a massive growth driver for them. I think it added 200 or $220 million in incremental revenue last year, but that also came with significantly lower margins. So that's the caveat of that. But the decision of reducing price on semaglutide, that's which the weight loss drug extended the, and it helped them drive better retention, but it's also eating into their profitability at a time where investors are looking for them to have growth backed with margin expansion and not dilution. So that's part A. Part B is also regulatory risk. Spooking the market. Management did take a cautious approach in their guidance. I think they only included semaglutide revenue in their Q1 because they anticipate massive restrictions on compounding, which good job because they absolutely deserves they have to do that. And I think they're allowed to sell it through like the first 5 months of this year, and maybe even longer if like they do some kind of legal finessing to extend the timeline. But either way, they aren't willing to bake any of that into their projections, which is great to see. But like I do think management is clearly making a bet that personalized health offerings can pick up the slack of the weight loss headwinds. So it's unclear if that can scale fast enough to fill that gap. But either way, like my eyes, the biggest, most important metric for me on Hims and Her Health is their margins, because that's where you can really see if a stock has pricing power, has a competitive advantage, a moat. It's completely different industries, but SMCI, you saw their gross margins erode the past couple of years. It went from stabilized 17 to 18% 2 years ago because of the first mover advantage they had to now it's 11 to 12%. That's because of pricing power from their competition. They have to continue to undercut their own pricing to stay at the table. That's not a moat. That's not an advantage. So I think Hims and Her Health needs to find that margin stabilization in order to like maybe communicate that they actually have a moat. Because telehealth is a commodity of a space. So this narrative will always overhang on Hims. But also, this could be an Apple Music versus Spotify situation, and they can come out stronger and like prove like we're actually a big dog in this space. Doesn't matter how big of a company comes in, we'll defend it, and you're gonna see it. But I haven't seen that yet. I need to see it in their gross margins, and that was a big red flag. So I'm not surprised to see it down 23% pre-market. But it's
Yeah,
also
nasty.
it's a highly short stock, so like maybe shorts cut like it's just a trading vehicle almost a little. It's weird, but it's just the volatility it has. It really is, and I think in years, not quarters or even weeks. So I thought it was gonna be. It's I was shocked to see it as a $10 billion valuation, and I think it's just course correcting a bit after that disappointing guide and big margin miss.
Yeah. No, fully agree. We had Zoom earnings as well. That's also taken a pretty big hit on the charts, right back down to those range lows on the daily. Not super surprised there. Again, double beat, but let's see what the AI
Three
summary is.
percent
Yeah,
revenue growth.
yeah.
God, come on, that's
It's just
abysmal.
in this market, it's not enough, man. It's just not enough. I don't see. I mean, we talked about Zoom yesterday. I just why, right? Yeah, we have that question a lot, and it's like why that opportunity when there's so many other opportunities in the market, right? So not surprised to see Zoom down. It's not that bad, to be honest. It's just at the bottom of these daily ranges. But again, I just don't see why I would want to be jumping at this. Like even on this dip, it's like okay, we're getting a nice dip, sure, but I don't want to buy this company, right? Simple as that for me. Revenue growth for year 26 is projected at only 2.7%, the midpoint, which is below the previously discussed mid-single digit target, suggesting slower growth than anticipated. Despite increased investments in AI, Zoom's non-GAAP diluted net income per share in Q4 was $1.41, which is slightly lower than Q4 of last year, primarily due to higher income tax and unrealized foreign exchange losses. While Zoom is making progress in AI, the management team stated that the macro environment is still mixed but stable, highlighting the ongoing uncertainties and challenges in the market, which may affect future growth. So, yeah, I just don't see the long term moat, man. Down over 4.5%, looking rough. But again, just like at the bottom of those daily ranges, I don't see why you'd want to buy this. You got any more thoughts, Shy, on that?
I mean, I almost want to create like a bucket of stocks that are called Walking Dead. That's exactly what
I
Zoom
love it.
is.
Yeah, should
It's
make that
just
a segment.
it's not it's a great product. It's a shit company. There's just
Yeah.
there's so many
That's another thing. I
layers.
use
Yeah.
that's where it's hard too, because I usually like to buy what I use, and I use Zoom almost every day. But I don't. There's no reason for me to own this. I mean, it's not like even Netflix. At least it's like okay, Netflix. Like look at the stock. You know what I mean? Look at what the stock is doing. It's like okay, glad to own some of that. But it's like Zoom. It's just it's not even performing like anything else that I use on a daily or own. So I'm just not. I'm not
I
gonna
mean,
be there.
it's the internal battle versus consumer versus investor. Like
Yeah.
I love Apple products. I'm doing the stream with an Apple product here and I'm on my iPhone. I would never touch Apple stock with it as an investment because I don't see any case for that. There's always examples of that, guys. So like I think it's really important to like try to see these kind of stocks 10,000 foot view of like what's the actual business case on why I should own this name, why it will grow. There is none for Zoom. Like I mentioned like last week, I think they need to own the college space, and I think that's the way to go. And their revenue can go through partnerships of companies that want exposure to that demographic because they own the 18 to 22-year-olds. Like that's their only advantage. But even then, I don't know. It's tricky. Like you're seeing, it's it's not Chegg. I'm not. I don't want to compare Zoom to Chegg, but Chegg is a commodity now officially. Absolutely with AI. Like Chegg is a dead company. It's an absolute dead company now. And
I think I
Zoom, I
played
just
that once. I never, I never really got into Jig.
yeah, I mean, it's just I just don't see a case for Zoom. There's better opportunities out there, but who knows? Maybe AGI needs Zoom's video specifically. Just no way. Actually, I just don't see it.
Yeah.
Weird.
We have HD earnings going on right now. That or the earnings call is going on right now live, which you guys can listen to on the StockTwits platform. So, reminder about that. But I think I'm gonna be picking up some HD at the open personally. I need to look at the option contracts because I don't think I'm ready for options. We just got some big down moves to some big targets for any bears, which means I think this could go sideways for a little bit. But nonetheless, I want to at least buy some shares after the earnings. I'm usually not a big trader right after earnings or right before anything like that, but I've actually been waiting for a setup on HD, and I'm starting to like what I'm seeing. So obviously, I want to see what I'm seeing on like an hourly time frame, a lower time frame on the daily, but I'm happy to start a position on the bit of a lower time frame and see where we go. But just love to see us sweeping these weekly range lows. As long as we can hold these weekly range lows at what is that, like 380, and we're not getting continued displacement to the downside towards that 357, then I'm totally fine with picking up some of this. And then I mean targets are really going to be that 426. I gotta watch that psychological level of 400 for me. But ultimately, I want to see that 426 and then into the range highs. But curious on your thoughts on HD, Shy. Well,
Housing is struggling, guys. I mean, that guide was pretty bad on HD, but I don't know. This is so not my lane. I don't even view it. I'm probably should not be talking about HD. I don't know
yeah,
much about it. I just know that housing is struggling with all the other stocks. So HD, I wouldn't be surprised if they had a weak guide because of it.
yeah. Somebody's thoughts on the consumer cyclical sector and travel services industry. That might be more your lane, Shy. I don't have any thoughts personally. I
There is
don't
a
know if you do.
I mean, there's a repositioning happening. Like cyclical stocks are defense stocks. So like if the risk on is fading, that's kind of where the money is going to sit at a bit. So and I forgot there was some company that recently that announced like this summer they're anticipating a big pickup in travel, a big one. It was like a major company called that out. And in my head, I'm like, that's so surprising to me because like I feel like a lot of people are suffering still on year four of inflation, and like the they're willing to spend money to travel abroad, etc. Like I don't, it's weird, but yeah, that the cyclical trade is only if you're bearish on the market and you think a recession potentially can occur, and that's a good, interesting place to park your cash. But I also think TLT is a better place to park your cash if you're going to choose a defense trade. Uh, and yeah, I mean, if there's a recession, TLT will pop like significantly. So that is somewhat maybe a good hedge on if you're bearish in the market or not. I wouldn't like cyclicals. I just there's too much noise around it, but TLT is the best pure play on that repositioning.
Yeah, just looking at the Nasdaq this morning too. We were getting that continued downside from yesterday, but getting a little bounce in pre-market here. I'm not jumping at the long really quite yet until I see some. I need to see more on the higher time frame personally, but I do have a 50% retracement marked of the weekly range so far. That's sitting at 610.25 on NQ. If I knew the conversion to QQQ, I would tell you. Let me see if I can just take a look here. 50% retracement of the week. I'll just get it real quick for everybody on QQQ. It's going to be 528.96. So I'm looking for market to kind of rebalance to that area, but I also think just based on the higher time frame and what we saw last week, I really think that was kind of the beginning only of this down move. And based on what we saw yesterday, we saw a retest of the exact area I wanted to see to go lower, and we went lower. And I mean, my next targets for NQ, if we do want to go lower, is going to be 940.25, which is that for QQQ, you could just go mark that Monday, February 3rd low. So that's what I'd be targeting on NQ. Next big spot on ES, that's 59.35.50. Again, I'm not this big bad bear on the market, guys, but I would play what's in front of me. I don't care. Up or down, doesn't matter to me. I'm looking to catch these big moves. So it really doesn't matter, right? I'm playing what the market is telling me, and the market has told us since Friday that order flow has flipped bearish completely at that 22,000 area. We've retested that to try and get bulls going again. They could not do it. And now we're continued downside, and we've made that 50% retracement. If we do bounce, I think a rebalance to there is fine. But I really don't have a whole lot of confluence for a big long quite yet. So we'll see if that maybe forms. But even if it does, I think it's just going to be a smaller, lower time frame long that really is just a higher time frame short later. And what I like to do is always be aligning the shorter time frame with the higher time frame. That's how you get A plus setups, right? If I'm looking at the higher time frame and we're in a setup for the downside, right, on the higher time frame, and I'm thinking this market's going to sell, why would I want to try an internal lower time frame bullish trade? It doesn't make sense, right? I'm always aligning the time frames together. So with that, I don't see the long quite yet on NQ, even with the nice bounce we're getting. But we'll see. We could absolutely bounce, and I'm totally for that rebalance, that 50% retracement. But as of now, I think we can still get this continued downside in the market, and market might be drawn to weekly lows, which is 940 to 650, really right there, 680. So I mean, I wouldn't be surprised if we end up in that range end of the week, maybe into next week, if we want to continue this downside. So we'll see. Any more thoughts on like the general market, Shy, or anything you're looking at for this morning?
I think all the Max 7 is, if that bucket's red, like took all the gains since December is now officially gone for the Max 7 names. Um, so I mean, you guys, I've been on this like stream for a couple months now. Like I've been very adamant. This is not the year for big tech, and I was shocked to see QQQ up 5% in the first 6 weeks. I was like, nothing I saw this earnings cycle proved that they should be up, and I was like, I was embarrassed, but like I was like, don't be in big tech. It's gonna be dead money for this year. They're treating this year as an investment year. You don't want to be holding a stock during that. So I'm not surprised, and I think it's gonna be a choppy, ugly, choppy year for that sector, and single digit growth return I think this year. So maybe it catches the bid, maybe Nvidia saves the day, but even then, it's not a good business case for 2025 for big tech, and reposition elsewhere. It's not like I'm bullish on Amazon. I'm still trying to get to Amazon, but like I've been making ads the past couple of days. It wasn't towards to Amazon. There isn't the urgency I have to add to Amazon. I think that's the sentiment that's happening in Max 7, where what is on sale right now? Like, is there a sale that's occurring right now in Max 7 names? Maybe Nvidia, because if they prove the party is going to continue, they are undervalued right now because the market's pricing them as a pretty minimal beat. It's I don't know. Like I think it's just one of those years they just chill out, and that's perfectly fine. But the past couple weeks, the future was on sale, but Max 7 not really as much. So I I'm not surprised. I'd be hesitant, to be honest.
Yeah, I'm with you. Thoughts on the data center and cloud storage sector from the chat, Shy?
Oh, I mean, we'll we'll find out tomorrow how much of impact
I was gonna
data
say
center
it's
demand
really all
is.
in the hands of tomorrow.
So
We'll find out.
I will say, like a lot of the commentary from the big tech this cycle was compute constraint. That's why their AI workloads were lighter than expected, um, and that's obviously going to benefit Nvidia. That's the main beneficiary of that. So like I feel like Nvidia will be just fine, but there's still absolute compute constraint out there, and especially and energy constraint out there. So it's not really demand related, um, and that's why you're seeing this year a lot of the big techs just spending as an investment year because they're so sick of being constrained on compute energy because like they see the demand is out there for AI, but like they can't fulfill it. That's frustrating as an organization when it happens quarter after quarter after quarter. So they're just treating this year as like we're gonna overly spend on capex, make sure we have all the tools necessary so we can actually hit our max potential on our AI initiatives. That's what this whole year is going to be about, and that's going to come at the expense of shareholders because that's going to be a margin compression story. And you're seeing revenue not accelerate at the pace of their capex incremental increase because they just don't have enough necessary tools in place to see it yet. So it's just one of those frustrating years. It's similar to Snowflake in 2024. If you look at Snowflake's chart, it was brutal to own Snowflake. It's because their margins were compressing. They were they didn't have as much compute necessary to create these go-to-market AI products because Frank Slootman, the prior CEO, just didn't believe in AI, so he didn't get enough tools necessary to make this AI products go to market. The new CEO did that, but he did they did a rapid pace to get as much compute as possible, and you saw their stock keep going down, down, down because their revenue wasn't really reaccelerating. The business spending wasn't picking back up, but their expenses were skyrocketing because they had to get that Nvidia compute in their tool house. That's kind of what's happening for big tech, and I'd be cautious. And it's fine though. It's not going to be like the bubble burst. It's just we're in the middle of that S curve. I really do think we're in the middle of that S curve for big tech, and that's great because it gives you time for them to cool off. The technicals catch up to it. It's not turning into a bubble territory. But people, and not people, like retail investors are just like so used to making stupid amount of money every year, like 15%
Well, that's
return
what
a year.
retail's driven by. They're driven by the joy of making money, and that's where it all goes wrong, right?
But exactly, it's perception,
Yeah.
expectation. Like my whole goal when I started my public portfolio 2 years ago was 15% a year. That's all. That's my goal every year. I had 87% the first year, 67% next year, last year, and this year. Now it's still 10%. But like when I say 15%, people are disappointed. That's a crazy thing to me. Like that's wild to me. I think it's a gut check that's happening this year where people are going to expect, oof, it's actually choppier than expected, and it's not so easy to make 15%. We needed this,
But
so
it's
I hope it continues.
opportunity, right? Look at what this
Hmm.
volatility has done. Like, obviously, again, if you're just not a shorter term trader or can't put that hat on for a little bit, sure, this time is tough. But if you can, I mean, this is just opportunity to make shorter term money, right? Like, no matter what your emotional thoughts might be on like what's happening in the world right now, it's just like this is all opportunity for us, right? This volatility that it brings, which I love for the shorter term trader style of things. You know what I mean? From the chat as well, we got somebody asked about coin. I wanted to talk about that because the downside has been ridiculous on coin lately. I was actually looking to be pretty bullish once we took those January 13th lows, the range lows. I was looking to be pretty bullish. But then you just see we just continue to sell through that level. There's really no aggressive buying happening whatsoever. Down to 217 in pre-market here. We're in a big gap where you could see some buying, but I just at this point that we lost that low, I think we're going to the next big range low, which is, I mean, first spot I'm going to look at is that 180 area, but really would love to see 146, which again, it just seems kind of crazy, especially when coin was just at, over $300. But I mean, I just let the chart tell me, right? And that's our next big range low that I would expect displacement to, especially on a monthly chart. At least like just under that $200 a bit, I think would make sense. So that's kind of where I'm looking for coin to go. I was gonna be really bullish, but I mean the charts are telling me not to be right now. So I'm gonna hold off on that until I see some real price action that tells me, hey, this is looking good. Because as of now, I mean, look at that gap down in pre-market too, just nasty. Not saying it can't get bought up, it absolutely can. It's just I don't think as of now, I don't think this is. I don't think it's time. But curious on what do you think about coin lately, Shy? It's been nasty, bro.
Coin, Coinbase and Robinhood. So
Yeah,
both
Robinhood's taking it right now.
they're both taking it, and I think it's crypto's what's been driving both of those names like the past 6 months. So both companies are clearly capitalizing on like the evolving financial landscape, which is crypto. Coinbase remains the high beta play on crypto, while Robinhood is kind of evolving to something much bigger. Like the way I like to say it is like Coinbase does weaponize volatility a lot more than Robinhood, where Robinhood is now becoming that ecosystem. So like the longer question that I think a lot of people have to ask themselves between those two companies is what's the better which model wins? Is it going to be the pure crypto infrastructure bet that thrives in boom cycles, Robinhood, Coinbase, or the fintech platform that's designed to weather all market conditions that's become this ecosystem. So I think if you're really if you think that Bitcoin's going to bounce to 90,000, like Coinbase is probably going to give you better alpha in the near term, but longer term, I just think that there's so much cyclical risk associated with the Coinbase where if the bear market occurs next year, like they're gonna push both those names lower, but I think it's gonna be significantly more impactful for a name like Coinbase than a name like Robinhood because Robinhood has de-risked themselves a bit from just being the weaponizing volatility, and also their Robinhood's crypto trading volume soared 700%, I think, last quarter.
A
Coinbase's
lot more
surged.
people are using it for that because it's easy. It's easy. I
Mm-hmm.
can just go on there and it's all the it's and if you already have investments and use Robinhood, that's even better because you don't have to change up. You don't have to download a new app or anything. It's so much easier than a crypto brokerage as well. You know what I mean? And I think that's big for a lot of people because like for myself I just hate that shit, you know what I mean. I hate how difficult it can be sometimes where it's just like can I just buy it like a stock and like you know what I mean, Shy, like
Well,
those crypto brokerages just piss me off
I,
sometimes.
I also think there's a narrative that eventually it's going to be a race to the bottom on commissions, like that
Yeah,
Coinbase has.
it
So like
always
that's an
is really.
inevitability.
Yeah,
Robinhood already crossed that barrier. That's why I'm like, Robinhood's such in different tiers than Coinbase, and even though Coinbase's crypto volume went up like 194% year over year, it's just you see Robinhood going up
what
700%.
happens when
That's
crypto's
wild.
in the weeds though?
Exactly.
That's the thing. What happens when crypto's in the weeds and all that volume goes away, and Robinhood's still getting all the volume because you can trade whatever you want on Robinhood, right? Like,
100%.
it's just yeah. I'm with you. I do like Coinbase though. Like as a trading vehicle, I actually really like Coinbase. It's a fun thing to trade options on, but. And I was feeling pretty bullish, but now it's just like I don't have much reason to be bullish at the moment. So, and definitely not like a long term company. I'm like investing in really. So, keeping that in mind. What else we got from the chat? Let's see. What's your opinion on the Russell 2000? Much more downside? Ooh, it's looking a little nastier than than the market, I think. Honestly, well, really just quiet. Actually, it's just quiet. When I bump up this time frame and look at a weekly or a monthly, I mean, nothing's really just happening. You know, it's just I never trade Russell because it's so slow. Uh, and I don't have much reason to be participating in Russell at all. And again, I mean, we've talked about the long term thesis about it, where it's like they're constantly just kicking out their best players, right? They're forever going to be kicking out their best players, so it's tough to be a big bull for me, at least like on the long term. Of course, like there's moments short term where it's good and you get those opportunities, but I feel like lately it's been pretty trash, to be honest. I mean, just look at that weekly chart. It's sideways. We've gone nowhere. Not a trading vehicle I really want to be participating in. Now, you could say the same thing about Nasdaq lately, that it has been going sideways. True, but also the points and the volatility on Nasdaq is a lot more when you're trading futures rather than the Russell, right? So that's the difference right there. And yeah, I mean that's that for me. You got any thoughts on the Russell and IWM, Shy?
Rates again. IWM is a third of his regional banks. Like people need to know that. However, I do think the 10-year yield is like tanking a bit. So I think there's some recessionary fears, or there's not going to be that much growth, and that's going to hurt small caps. So something to monitor. I still think everyone's waiting for the stock, small caps to kind of have their moment in the sun and like outperform. Maybe it's this year. I think it might be, but yeah, that's my 2 cents on that. Small, just you have to be patient. You have to think years in small caps.
Yeah. I'm gonna real quick. We got a guest we're gonna bring in, but real quick before I just wanted to talk Tesla real quick because on a long term perspective, a lot of people I feel like bump up your. I know things have been kind of like nasty in the beginning of the year, right? You've seen a decent amount of downside, but even with the downside, I don't think it's been as nasty as it definitely could be. Um, re- Regardless, you got to look at Tesla from like a higher time frame instead of 5,000 feet. Look at 100,000 feet, right? And it's like look at that yearly chart. Tesla, the current administration, in the next 4 years, and Tesla is down 26% on the year. The last time Tesla was down, what was it? Yeah, we got down to 44.5% on the year, and then ended that year. That was just this last year up 61.5%. There's that bell too. So just keep that in mind. I'm just throwing that on people's radar. You know what I mean? Not saying do anything with that, but just take that thought how you want. Tesla's down 26% on the year. Think about that. So just throwing it out there for people. We got our man Austin in the lobby. He's gonna come and join us for the morning. There he is. Austin, how
Gentlemen,
we
how we
doing, man?
doing?
Good morning. Good morning. How we
Good
feeling?
morning, good morning. It has been, is it a good morning? I mean, geez Louise, what a heck of a couple days,
Have you been
man.
surviving with the downside or what?
Yeah, dude, I have been. I think I think the first thing I said when I joined you guys, maybe it was 3 or 4 sessions ago, was that volatility is going to be a major theme of 2025, and we've certainly seen that. We've certainly seen that.
Yeah, 100%. I know you got some stuff you wanna share. So did you wanna
Yeah,
get into
happy
that?
to.
Yeah.
Yeah, so obviously every time I come on here, just I don't want to, just ramble and predict stuff. I want to share some ideas and, of course, provide value to your thousands of awesome listeners. So,
I wanted to get your thoughts on a few tickers too, as well. So yeah, I'm
yeah, we
excited
can
for the show.
definitely, yeah, let's definitely do that. So, I guess, like, in my opinion, like the big like make it or break it for where we are right now in the markets, at least in the short term, is Nvidia earnings. So, I
Mhm.
kind of want to spend like maybe 3 minutes just like looking forward to what that might shape up to become. But I guess before that, there's a couple things to consider around this like bearish narrative right now. We saw Walmart's earnings report. It was disappointing. That was last week, and I'd even argued they're still pretty overvalued historically speaking. I think they're trading around 35 times PE. Their historic is around 23 to 25. Initial jobless claims saw an uptick. PMI dropped, hinting at a slowdown in business momentum. Consumer sentiment fell, but I think this was more catalyzed by inflation more than anything else. Retail investor favorites like Hims and Palantir, they got absolutely crushed, right? They're sort of, I wouldn't call them bubbles, but their bubbles have popped, right? We can talk about some more tickers there, of course, but those are kind of the two like biggest retail focused ones, and we saw them come down. We've also seen large signs of de-risking from the hedge fund community. During last week's sell-off, hedge funds de-risked aggressively in big tech and just tech in general. This was actually a top 4 risk-off event in the last 5 years for hedge funds. Was last week, right? Top 4 risk-off event, get me out of here, in the last 5 years was last week. We all know the S&P 500 tends to experience a 10% correction, once per year during bull markets, sometimes 12, sometimes 13 or 14%. That I think is a 68% chance that happens, dating back to the S&P 500's inception. So I very much think we could be gearing up to experience one of these corrections in the coming weeks, months, or quarter. And again, just to kind of reiterate, I think Nvidia's earnings tomorrow are going to be the big sort of catalyst that might say, all is clear, let's go for another leg up, or wow, that is not what we were expecting them to guide to. We're running for the hills now. So to give a quick preview on what some of the banks on Wall Street are expecting from Nvidia's earnings report tomorrow. The first off is strong Q4 results. Call it around 40-ish billion in revenue compared to consensus estimates of about 38 billion. Hopper demand was especially healthy in Q4, and Blackwell contributed quote unquote several billion, as these banks like to think. Base case for Q1 is an outlook that is in line with this sort of 42 billion in revenue expectation. So as you listen to this earnings call and they share their sort of outlook for Q1 and the rest of the year, 42 billion. If it's above that, that's wonderful. It's below that, could see some volatility. Hyperscaler CapEx trends, of course, remain solid, and recent conversations with supply chain checkpoints point to no slowdowns in Blackwell, which is great. Additionally, there's not exactly concern about the sort of impact from these efficient models like DeepSeek. I would be surprised if they're going to sort of talk about that in the earnings tomorrow. But from a gross margin perspective, and this is where I think I want to give a quick shout out to Jaguar Analytics. We all know Jaguar on Twitter, or X rather. He had shared this statistic about Nvidia's gross margins shrinking from like 78, 80% now, all the way down to about 72% where we are, which is sort of a sign of like market dominance, not exactly, having that staying power. You discount your products because there's lower demand. And so bigger discounts, lower gross margins. So keep an eye out for that gross margin. Again, Wall Street's expecting about 72%. But I believe if we see again another beat and raise from Nvidia, we could be back off to the races. Where on the flip side, if we see lower than that 42 billion in expected revenue, perhaps lower than expected gross margins, or any other just hiccups along the way, we could see a very volatile couple weeks.
Yeah, I think it's gonna be a crazy end to the week. That's for sure. Everybody and their mother's waiting on Nvidia, right? So, and I'm with you. It's gonna be a big decider. I guess going into this, I'm like the most bearish on an Nvidia earnings I've ever been. But like, I'm not. I don't want to be this big bad bear because I'm not. But like, I don't know. This market's changed, and
It certainly has
given the way
changed.
it's looking right now, I'm expecting it to not go as well as maybe people think. But I'm happy to be wrong, right? I would love to be wrong on that. Let's see. I just don't.
No, I
I
totally
just
agree
don't
with you,
know.
and it really just like highlights what I believe it was Shy last time I was here, maybe the time before, was saying how we always say it's a stock pickers market, but like it's really a stock pickers market right now. I mean, the easy money has been made, and as we look toward deploying net new capital, it has never been more important to be incredibly stringent, incredibly disciplined, and follow a sort of rules-based strategy that you obviously come up with and implement yourself. This idea of like rising tide raises all ships. I feel like that sort of rising tide of like the reversion to the mean that we experienced in 23 and 24 is gone, and now what's going to rise or raise ships rather is positive earnings, free cash flow, things of that nature. And it really just comes down to like finding those things in your own portfolio, finding those names, being risk on when you need to be, and more importantly, risk off when you.
Uh-oh. Did he cut out? Oh, you cut out for like right on the last word
Oh,
there.
I did?
Yeah,
Oh,
yeah,
weird.
just
I was
for
just
like a
saying to be
second.
risk on when you need to be risk on, and then risk off when it's important to be risk off.
Yeah, no, absolutely. I'm with you. I wanted to get your thoughts on a ticker, actually HD, this morning. They just had earnings. I actually,
Oh, cool.
I want to get options on this name, but I'm not ready for that yet because I do think this is going to get a little bit choppy here just after earnings. But I picked up some shares just into the open here because I am seeing a little of what I want. So, but curious on your thoughts here. I know things have been a little rough on this name lately.
Honestly, one of my favorite things to do when anyone's like, "Hey, Austin, what are your thoughts on XYZ stock?" is I always pull them up on fast graphs
Mm-hmm.
because I think fast graphs does a really good job of illustrating how a company's earnings, rather stock price, has moved in tandem or against their fundamentals. And those fundamentals could be cash flow, it could be earnings, it could be adjusted EBITDA, price of sales, whatever. I'm looking at, I can't share my screen, but I'm looking at Home Depot right now on fast graphs. And is that a thing? I can share my screen? Hell yeah, let's
Yeah.
do it. Let's give that a grow. And so I'm looking at Home Depot right now on fast graphs, and it's pretty obvious, right? Let's go back. You can kind of see the clear trend between the stock price in black and their earnings in blue, right? Obviously, we had the COVID bubble. We shot to the downside during that, but now we're way overextended to the top. I like to zoom in just a little bit. I don't care exactly what happened back in, 2011, right? The business is
Yeah.
very different today. So I like to zoom into the 12, 10, maybe 8-year mark, but it's pretty obvious. They move in tandem. We have some, swings to the up and swings to the down. Seems like right now is a swing to the upside, but Wall Street's expecting earnings growth of 4, 9, and 9% over the next, call it, handful of years. So is this a name I'm buying? I love Home Depot. I own the stock. I opened most of my position in early 23, early to mid 23. So I think I'm probably closer to the maybe low 300 range. But am I adding at these levels? Probably not, right? It
Yeah.
seems like we're
I want
coming
to be
back
clear
down
too.
from
I'm
a
I'm more like taking a shorter term trade, right? Like this
nice,
is not
nice,
more.
nice.
Yeah, this is not like investment levels for me. But yeah, just want to make that
No,
clear
I
too.
love that. I love that, clarity there. So what do you see that makes it an interesting short-term trade setup, right? So
Well,
for
I
like,
guess I'm just zoomed in a little more, right?
yeah.
When I look at a weekly chart and I zoom in, I mean, for me, I see we're at the bottom of this weekly range that we've been just consolidating in after this giant impulsive move up. And I'm seeing aggressive buying right after we take those lows. So, a lot of people will think, oh my God, we're going to break these lows and then it's going to hell. And for me, I like to see us finally break a low and then that's when the buying comes in, right? A sweep of
Yeah.
liquidity essentially, right? And so that's what I am seeing so far on HD. And then I bumped down the lower time frame, the hourly, and I'm getting some of the points of confluence I'd like to see to take along. But again, we just displaced to this massive like bearish target that the bears were targeting, right? So I do think some sideways action could come. That's why I'm just doing shares. I want to do options. But really, I want to see my points of confluence on a daily chart, right? Which we're starting to see right now. We just made this kind of this gap, this imbalance here that we're trying to run through. I'd love to see that, but I really want to see like a market structure shift, right? I want to see actual shift in the trend here
Mm-hmm.
on that higher time frame. So I'm kind of just waiting for that, but wanted to pick up some shares and hopefully get a move just back to these range highs, basically 426 to that 440 area, right into those recent highs. So that's what I'm kind of looking for here, just on the shorter term. But
No,
yeah,
I appreciate that, Jordan. I'm
yeah.
curious, and Shai, I would love to get your perspective on this too. How are you guys thinking about, obviously pullbacks happen, it's part of the game. Do you guys have a watch list that you say I will begin buying on these specific levels? Talk about long-term investing here, right? Do you guys have maybe a specific, handful of names that you already own and you're trying to dollar cost average into, or are they new names that you don't have in your portfolio yet that you would only buy if they got down to specific prices? I guess that could be just really helpful for maybe some of the people listening right now that aren't exactly sure how to approach a, bull market correction.
Yeah, Shy,
Jordan,
you
you
want
want
to
to
go?
go?
You
No,
want me to go?
mine's gonna be way longer.
Okay,
So like, I
I'll
think you
go
maybe
for it
should
real
go.
quick. I mean, for me, to be honest, okay, I have done more of like the stock picking with my long term investing over. I mean, since I started it, so I've done well for sure. But I'm getting to the point where I really like just want to hold my Tesla, like hold my biggest investments that I really love and believe in, and pretty much sell all the other names and just be buying S&P. To be honest, I'm more of an active shorter term trader, so that makes it easier to invest in the long term for my side of things as well. Because like you guys say, I mean, no matter what market it is, stock picking can be freaking difficult. You know what I mean? And when I'm worried about the more shorter term charts, I just think it's so much simpler for me to just, hey, I could simply be DCAing into something like VU. And then when we do get these big market corrections, I mean, that's when I'm throwing in big limit orders to capitalize on those big market corrections, just like we saw in 2022, right? I was buying up a ton of names, but at the same time, I could have just been loading up into VU, in my opinion. And now, of course, you're going to miss out on certain opportunities, like something like Nvidia, right? If I was just doing that from the beginning, I probably wouldn't have had Nvidia in my portfolio. But even with that, the S&P did capitalize with Nvidia, right? So it's like you still get a piece of the pie. And I
Mm-hmm.
think for maybe someone who's a little more active on the short-term charts, or really not active on the charts at all, that's probably a better route for most people to go, is just have those limit orders ready for when the market takes those big corrections and be DCAing otherwise. But I'm curious on your thoughts on that, Austin, because like I'm less of a long-term trader. You know what I mean? I love the long-term stuff, and I love when I pick a good company and it works out. But for the most part, I just feel like I would do better over a longer period of time, just simply buying SPY, make it easy.
Yeah, I'm right there with you. I've got, um, I would say between like SPY or call it VOO, whatever. Just call it like just general index funds. I would
Yeah,
say,
yeah.
across all the general index funds, I've got hundreds of thousands of dollars invested. And then when it comes to single stocks, I've got about 150-ish thousand invested. Um, So you can kind of like figure out those ratios there. But when it comes to single stocks, and I probably should do this more than twice a year. Um, I didn't really have a reason to do it in 24 more than twice a year, but now obviously with this volatility in 2025, I do. But kind of back to what I was alluding to when it comes to fast graphs is like I've got, 20, 25 companies in my portfolio that I'm more than happy to sit down if it's quarterly, every other quarter, more frequent, whatever, but just pull up that graph and it's like, okay, historically speaking, does this stock price move in tandem with their operating cash flow like Google and Amazon? Does it move in tandem with their earnings like we just saw with Home Depot, and JP Morgan's a great example of that? Maybe does it move in tandem with their EBITDA? Maybe they might be unprofitable, right? But like, how do I kind of observe what names in my portfolio, historically speaking, are just like way overvalued? And I'm not someone. I'm a big believer in like, and I know Caleb Franzen says this all the time. We should all be net buyers of assets. I'm a big believer in being a net buyer of assets. I don't want to like try and time the market in a sense where like, oh, overvalued, I'm out, waiting for it to come back down.
No,
When I,
because that's not
when,
what the market's done for all of time, right? I
exactly,
mean,
and
look at
and
it. You
so
got to bump up the time frame and look at a chart from way back, right?
I totally agree. And so when like in this instance, just a couple moments ago when we looked at Home Depot, it's like, is Home Depot overvalued? Historically speaking, it is. But does that mean I'm selling my Home Depot stock? No, it just means I'm not buying more of it at these levels because history tells me that we will come back down at some point from a valuations perspective. And so whenever I think about like taking advantage of a bear market, not a bear market, rather a contraction or a pullback in a bull market, which I think is what this is. Um, it really just comes down to like opening up what my portfolio looks like from valuations perspective, who is undervalued, who might be overvalued, who just kind of picking and choosing, let's call it 8 to 12 names that really do deserve some more capital, which normally is what happens, right? Call it 25 to 35% of the total portfolio ends up getting back into sort of like this long-term sort of trend, historically speaking, from a valuations perspective. But Shy, I'd love to hear your thoughts as well, my friend.
Yeah, so I'm an absolute thematic investor. So I like to identify themes that are undergoing a structural shift that's going to affect multiple industries. So you need to have a long-term mentality when you're that kind of investor. And so for me, AI, quantum computing, space, cloud, e-commerce, like those are kind of thematics I'm really bullish on. And the past couple of weeks, the future has absolutely been on sale. It has been. A lot of these winners are pulling back 20, 30, 40%. So I started raising a couple weeks ago. Like I mean, past couple weeks, I've been saying like I'm raising cash. Like it's my biggest position. That's 12% of my portfolio is cash. As of 2 weeks ago. Now it's like 8%. I've been offloading it recently, and I do feel like I'm a fat kid in a candy store a bit right now, where nothing like whenever you get these high conviction names or those clear winners that the market's validating them as what your thesis was originally, and they're validating it with the multiple expansion or it's backed by fundamentals, whatever it might be, it gets pulled back 20 to 30% on a macro driven reason. That's like music to my ears. Like I love that. So I think I'm a perma bull, not maybe not a perma bull, but like I think AI is absolutely the fourth industrial revolution, and like we are so early, and the stage two of it literally just began 3 months ago, and that's gonna happen. That's where AI meets permanence. It's gonna last years, and knowing that, I'm not gonna let the high stakes poker game that Trump's playing that nobody knows how long that's going to take, but that's causing the bond market to overreact. It's causing the dollar to strengthen. The tariffs potentially impacting a lot of the guidances. Like that is all just a bump along my long-term journey as an investor. So I'm not going to let that become a headwind. I'm going to be very slow with my adding. I still think valuation is definitely not, it's not on sale, but there's certain names like that their thesis isn't cracking at all from their earnings, but they pull back significantly. Like I added to Axon Technology, ticker AXON. Like that's one name. They are pulling back significantly due to maybe some competitive headwinds due to flock, but really it's not. It's not the case at all. It's almost like you're a it's one one of their vendors. It's just say you're a premier restaurant in LA. Mastro's. Just say you're Mastro's. One of your vendors that delivers the food for your restaurant decide, oh, actually, I can probably do something similar. I'll create a mom and pop shop on the side. That's cute, but you're still no Mastros. Like that's you won't be able to compete with us. But the market is re-rating the stock as like a potential competitive headwind now because they were always this monopoly in public safety and defense. There's a drone angle with them as well. They have this whole ecosystem around the hardware. Like everyone knows them as the taser company or the body cameras that cops wear. That's Axon. But really, they're the cloud ecosystem that stores evidence as well. And if you guys don't know that that space, public safety, is one of the toughest, highest barriers of entry there is out there. Axon owns the end to end of that hardware and ecosystem, and they're one of the strongest moats I've seen in a company under 50 bill. So when Flock, one of their customers that now is turning to a potential competitor due to Axon cutting the strings, seeing what they were doing, I'm not worried. And your market's giving you a 30 to 35% discount now on the stock, but it was a very expensive stock. It was always 100 times free cash flow multiple. Like it was always priced way up there, but it's because they had a monopoly in a growing thematic. Look at
Not to
ISRG,
interrupt,
Intuitive
but I do
Surgical.
want to just like double click on some of the verbiage you're using. So like you mentioned like like a discount, right? So it's like it went from let's call it and I love Axon, I made a whole video about them. But it went from let's call it like $710 and now it's at like 491. So like yeah, let's call it like a 25-30% discount. And so like it's a discount from recent all-time highs, right? So like how do you think about value? Let's say that someone is looking at Axon right now for the very first time. You mentioned, 100x on free cash flow, which is historically just like very high. But
Mhm.
like, how do you go about trying to figure out the fair value of a company, looking at it for the first time without reflecting upon, oh, it's got a recent pullback, therefore this is an opportunity, right? So like at let's say that it went from 450 and now it's at 490 and this big sort of November 6th through February 21 on the graph is just like gone. How would you know that like now is a good time to like buy it or accumulate more shares or like kind of give me the breakdown there?
So it's a tricky one. That's a great question because I've studied this company for years. I've owned it for a while in the low 100s.
Yeah.
So I know that company inside and out. I know the thesis. So when I see a massive move like that, always have to ask myself, is the thesis cracking? Like for the trade desk, that earnings report, that may be the case. The thesis might be cracking for having a standalone premium product outside the wall gardens. I don't know yet because Jeff was very sketchy on his conference call. He didn't provide any answers. For Axon, the flock moving out of their ecosystem, that's not thesis cracking. To be honest, it could be thesis strengthening because now maybe their ecosystem is going to be even more closed due to this, like what occurred in past couple recently, that they're going to be more defensive now about it. But knowing like the thesis didn't break, so I'm looking at the multiple. If the market was willing to pay 130 times free cash for the stock a couple weeks ago, and it's down 30%, a new competitive headwind that isn't really a competitive headwind, I'm like, all right, if that's not the case and the market realizes, oh, it's not going to be an actual competitor, it's going to be some cute standalone that really won't stand a chance because they don't have the full ecosystem, I think it gets re-rated to 130 times potentially. So that's part A. Part B is I think there's a massive TAM expansion opportunity that market hasn't seen yet for Axon. And I think it's going to happen in retail. I think a lot of the Walmarts, Targets, their clientele are going to, their employees will start having to wear those body cameras. Unfortunately, the public safety in this world is getting worse and worse. It's deteriorating and it's getting pretty ugly out there. And I do think that public safety is only going to expand in the coming years, decades, and it's applicable across so many different industries. It's not just police stations. Like it can happen in retail. It just the TAM is mankind, and the reason I say mankind is drones. Drones is inevitability for public safety in the future. Nobody knows how quickly, but the technology behind those drones for the public safety element is going to be using Axon. So in my head, I'm like, multiples are important, but for a company like Axon who has a monopoly on public safety, that's essentially the TAM is mankind. And they're a $40 billion company. That's $38 billion now. So to me, I'm like, if that's the case, this is going to be a mega cap because nobody else can do what they do. Nobody else. And they have a founder-led CEO who's incredible at what he does. And I have so much faith in the company where I just think the multiple will catch up to them eventually once they mature. But I think this is like a 22 to 25% CAGR for the next like 5 to 6 years with their margins they have already. It's just gonna compound. So that's hopefully that answered your question, Os.
It definitely has, and I'd love to share my screen because I'd love to ask another, and I'm just I love learning. It's amazing. So like this is such a cool example, like to your point, right? So it's like this is their stock price in relation to like their earnings on Fast Graph, and you can see like it followed it kind of down here in 2017, followed it up throughout 2021. We saw some contraction in earnings. I think it went down 7% here from 21 to 22. They definitely had a sell-off. Obviously, we were in a bear market. And then like we had like this crazy vertical and now we're coming back down. And so like I'm thinking like, okay, as a long-term investor, where should I begin to think about adding a position or opening a position in this company, right? Obviously, we see that we can trade up to 85, 75, 90 times earnings. Right now, we're trading around 94, so just a little bit, above that, it was up to 130. So, like, in my brain, are you thinking, or even just like, and maybe just another broad question, I don't ever mean to put you on the spot, I'm just like super curious. So like, is there a general price that you're like, yeah, 450 a share, 400 a share, or like, 550 a share? Like, are all of these sort of prices that I'm throwing out here, are they all fair game? Or would you think like you'd maybe wait for this to come back closer to its like long-term sort of 68 times PE range here, which is around like the 430-ish? But I don't know. I'm just like, how does someone like me who's like, I want to open a position in this name, how do I look at this and say, where do I even start?
So, I mean, another great question. So, when I'm really bullish on a name like Axon, like guys, I'm like, you guys heard me talk about it. I'm super bullish. It's a 3% position for me. Why is it not a full position? Valuation,
What
but
is a full position in your
five
port?
percent. That's
5%.
I was gonna go, yeah, 5% is a full position. So like if I'm interested in the stock, I add 1% increments, and the full position for me for Axon is it's they're 200. I use technicals a lot for the full position, so they haven't broken their 200-day moving average since November of 2022. That's a long-term trend line defense.
That's great.
That level is 460. So to me,
460. Okay, perfect. So
yeah.
see, that's what's so fun about this. It's like if we look at historical, fundamentals and like PE ratios, we can
Mhm.
then pair those now with some TA. And so it's like,
Yeah.
okay, Austin, it's at let's call it 500 a share. If you are optimistic about earnings, like obviously they're going to grow by 24, 25, 26, 28% EPS over the next 3 years, which I think is a great, you should own the name. 460 range is kind of where it makes a lot of sense to open up a position, which is right at that 200-day moving average sort of like support.
No, exactly. So I honestly, if it goes lower than that, I might make it this. I want this. I have a bonsai section in my portfolio. Bonsai is like five. It's right now 5 names are in there where it's defensible moats. There's no competition. It is just owning that whole space. Axon's one of those. And during the bonsai, the way reason I call it bonsai is because whenever there's I finesse it to make sure it's a heavy component of my portfolio to make sure it's always at 5%, 8%, 10%. This is one of those names. So like I want to make sure I own 19 names in my portfolio. The top 5 is 55% of my portfolio. Those
Wow.
5 I want to be my bonsai. It's because I'm riding or dying with those 5 names because how of a much of a moat they have. That's kind of how I do my portfolio management. And Axon's definitely one of those names. I'm still waiting for Cloudflare to pull back more because that's a 4% position for me. I want that to be even more, but maybe I'll get an Axon type sale for Cloudflare soon.
Now, how is the how are these 55% weightings and like everything else like broken out in relation to like a long-term portfolio? Like, do you own index funds and ETFs and like
No, just
thing-
pure companies.
really?
Because I do first my favorite part of investing is R&D. I love deep diving into stocks. That's my favorite part. So like past couple months I've been doing minimal adding. I've been digging deeper in my companies. That's my favorite part. I call it like I'm in the lab doing work. Like that's my lab work. So like Palantir is my number one position. I've trimmed 50% of it during this run, the past like 6 months. It's still 12% of my portfolio. So like usually if I build a full position in my bonsai names, they turn into much bigger components of my portfolio over time if my thesis is right.
Yeah.
So at the end of the day, like if I started from scratch, I wouldn't put 55% of my portfolio in 5 names. That's irresponsible. I'd probably segment it out as like 4% each and see where it goes. The winners turn into compounders and they become a bigger weight. Like CrowdStrike, average cost is 120 and then turned to a bonsai portfolio when it 4x'd. It turned into that like 8 to 10% position. Like that's
Yeah.
why for Axon, I don't want to make it a 10% position. I want to earn it. And by earning it, I give it 5% portfolio. And it's all up to you now, Axon. You carry the rest of the way.
It makes a ton of sense, man. That's awesome. I appreciate that breakdown.
Yeah, really good stuff, boys. I think we're good to wrap up for the morning. But Austin, always a pleasure talking with you, man. Always
Dude,
love having you
for
on the
sure.
show.
Absolutely. Oh my goodness, we got the Nasdaq down about 1%, the S&P down about 40 basis points.
Oh yeah, bring the blood.
Quick, what's everyone's biggest L today? I've got Hims down 25%. I'm not sure if you guys knew this,
Let's
but
see.
Hims turned into my
Mine's
first-
Tesla for sure.
Oh yeah, yeah, okay. Yeah,
Wow, the
Tesla,
market just
5.5.
did pull
Down
back.
5. Yeah,
Jeez.
I'm getting cooked on Tesla on my long term right now. It's okay. We don't look at that. We just focus on the short term accounts and don't look at that.
Well, and the good news, we got Home Depot, Lowe's, Oscar Health. We're all up in the green on that. Berkshire
I
Hathaway.
am in there. Let's go.
Yeah, dude, Oscar Health. Waiting on that one to really turn into something interesting in the coming, let's call it months and quarters. Really excited about that.
Yeah, I'm keeping an eye on it with you as well. So again, really good stuff. Appreciate the audience. Make sure you guys are liking and subscribing on the Stock Twitch channel. Austin, we'll have you on again soon, I'm sure.
Yeah,
And,
thanks so
and
much.
yeah.
And if this stuff is interesting, subscribe to my newsletter,
Absolutely.
gritcap.io, gritcap.io. There it is.
Yeah, everybody take advantage of that. This man is you're gonna want that newsletter. So appreciate you again. Everybody enjoy the day. We'll see you bright and early in the morning.
Cool. Thanks, everyone.